All right. Hey, everybody. Thanks for joining. We've got a really great webinar for you guys today. This is our now recurring quarterly deal flow update. So for those of you that weren't on the first iteration of this, last quarter, we presented our trade tracker, which is the spreadsheet that Charles, our director of acquisitions, is sharing via his screen here. And that that video, that webinar, we shared the trade tracker, kind of why we're doing it, and what is making up the different components. And so now it's been so popular and such we think a great tool and insightful way to keep up with deal flow. We are making it a quarterly webinar. So every quarter we'll be sharing our deal flow insights. This is our real deals that we're looking at. So Charles has censored some of the sensitive information in the spreadsheet. So we're pretty much showing as much as we can without maybe what feels to us kind of going a bit too far, sharing. But anyway, what my point is if I highly recommend everyone who is tracking deals to do the same for their own deal flow. And what you don't see here is the name of the deal, the broker that we're working with on the deal, and maybe some other things. But I would recommend keeping track of that stuff. So we'll wait for a couple more people to join here in just a few minutes, and we'll dive in. But I just wanted to share. I'm bursting with excitement here. It's going to be a good one. So that's why I'm jumping in already. But yeah, so yep, we'll just wait another minute. And thanks again for being with us. Okay, all right, we can go ahead and get started. So, hey everybody, my name is Rob Beardsley, Principal Lone Star Capital. We're a multifamily owner-operator focused on Texas workforce housing. Today we have with us Charles Waldron, our Director of Acquisitions. Charles, you want to give a quick intro?
Hi, yeah, Charles Waldron. Do acquisitions here. I've been with Lone Star now for almost 2 years. So I maintain the broker relationships, in Houston and our other Texas markets. Make sure we're up to date on the deal flow. And look at the deals and kind of figure out what we think of them and bring them up further along.
So, and Charles is sharing his screen here, and this is for those who are joining just now. This is our trade tracker where we take not every single deal, but the deals that are kind of most complete that we've fully underwritten, and we put in various data points about each deal. So what you see here, we've got I don't know, somewhere around 70-ish deals. We'll get into the specifics in a second, but we've got 70-ish deals from all our deal flow for Q2 2021. We underwrote more than this, like I said, but this is just what made it into the tracker for various reasons. And this data set gives us a good understanding on where the market is, what deals look good, what deals don't look good, and what does that even mean when a deal looks good, right? So we'll get into a discussion later about return metrics and things like that. But yeah, let's Charles, why don't you kick it off with kind of some of the so I just wanted to make that clear. Each row here is a full deal unto itself with a full underwriting where we've priced it, underwritten it, bid on it. So the various components here are the guidance pricing, which we get from the broker telling us this property is, we're guiding to this price. And then we come up with our Lone Star value. So obviously, most of the time, our value is less than the guidance price. Otherwise, we'd be buying everything in sight. So that's the difference. And obviously, the deals where our pricing is in line with the guidance and where that eventually trades, then we have a real chance of buying the deal. So that's what we're looking for. So yeah, Charles, I'll hand it over to you now.
Yeah, sure. So as Rob said, this sheet, every single row here corresponds to, we did a full model on this and put in, some projections on how we would operate it and what we think it needs and, where we see it turning out. And, we valued each one of these, did dig into each one of these. And, so here, yeah, just under my cursor, you can see the Lone Star value, like our pricing versus the guidance pricing. And then on a per door basis, just here to the left. And obviously kind of general deal stats, the market, how many units in each one, what year it was built, how many square feet in total, the average unit size in square feet. So, square feet per unit. So this deal's got 1,080 square feet per unit, kind of a little bigger. And then kind of coming along to the right here, we show cap rates, kind of at both the guidance pricing, what the cap rate is, and that's going to be tax adjusted. So this isn't just trailing. We've adjusted for tax and things that are going to, we're going to have to pay regardless of where the current owner is. And then we've got at our pricing what that looks like as well: cap, yield on cost, and the improvement, and then IRR, and all this stuff here, right? So anyway, yeah. So we got overall, this time we got 70 deals in this tracker. Just kind of some summary statistics. 238 average units, 1981 average year of construction, 834 square feet a unit on average, 99,000 a door, asking price on average, $22 million deal size. And so there were 70 total, and this time there were 50 marketed and 20 off market. I think, that's actually a little split from quarter one, where we were at 34 off market deals and 25 marketed deals. I think part of that is we just tended to pass on marketed deals. Part of that there is more marketed deals now. And I think, since the beginning of the year, as things in the market have continued to kind of return a little more towards normal, owners are kind of less going the kind of like, let's just send this to a few people. They're going to go the full way because they're feeling like that's going to work. So yeah, I mean, there are a lot of summary statistics here, and we got a comparison with last quarter, and I guess some other stuff here. Yeah.
Yep. So the summary statistics are kind of where the real value is here. The data at the individual deal level is good, and but the summary statistics is, some of the interesting stuff. Especially we compared some of the data from Q1, where we first began this, and then now Q2. So Charles, why don't you highlight just some of the things that we've been discussing over the last couple of days about kind of some of these averages and whatnot.
Well, yeah, I mean, I think the first, cap rates appear to have come in a little bit. So in Q1 we averaged at guidance a 4.1 cap, and now it looks like a 3.8 cap tax adjusted. And this is like an average. Some of them are going to be, more value add. They're probably below a 3.8, and some of them are going to be a little more stabilized. But I mean, even for the stabilized ones, you're lucky if you see a 5. So this is so last quarter was 4.1, this quarter 3.8, and the same thing with yield on cost. Also came in from 5.6 to 5.4. So it's there's been 20 to 30 bips kind of shift inwards, and you can see it also in our underwrite. We're underwriting that we would be buying a 4.5 cap last quarter, and this quarter we're now at 4.1 cap, and likewise for yield on cost we were at 6.2, and now we're at 5.8. So we've also come in a little bit, sort of 40 bips actually, but yeah. So the market as a whole appears to have not got cheaper, at least on that front.
Yeah, and so it's interesting to see, the small cap rate compression, and obviously this data isn't super robust, and there are uncontrolled variables, such as we might be looking at nicer deals that have a lower cap rate, and that's what's causing our average to be lower. But it just looks like from our statistics, our average statistics, kind of the vintage and whatnot is pretty similar. So, and we think we're generally looking at the same deals. So, um, one of the interesting things that we learned from the data here is that while the yield on cost went down, and for those of you that don't know yield on cost, that's basically your pro forma NOI divided by your purchase price plus capex. And so it's kind of like a future cap rate. So you might be buying a low in-place cap rate, like Charles mentioned, of let's say a 3 cap. But if you've got a nice value add, you might be able to push that all the way up to a 6% yield on cost by raising income and implementing your value add. So at the end of the day, cap rates are really important, and we'll actually one of our main points will be actually stressing the importance that we place on in going in cap rate, which is actually interesting because you hear a lot of people talk about, oh, well, I don't really care about the in-place cap rate because I'm a value add buyer and I'm just going to value add the deal and that's what's going to make the numbers work, which, yeah, of course. I mean, we've been successful buying negative caps, right? And but those, we'll get more into the specifics, but they have their risks and all that good stuff. So, but at the end of the day, irrespective of your going in cap rate, you have to have an attractive yield on cost. So out of all these metrics that we're covering, it's certainly one of the most important, and it obviously translates to then your levered IRR. So Charles, can you kind of zoom in and show how the IRR is pretty much the same, where we've got differences in cap rate and whatnot. Isn't that right?
Yeah, so here you can see, I hope everyone can see this. I just zoomed in a little bit. I think it was probably a little small at the beginning. But yeah, here you can see that, Q2, we're at 20.5 IRR, and Q1 we were also at a 20.5 IRR as far as what we were kind of solving for at our price.
Yeah, so it's pretty cool to see our consistency there as far as the average IRR that we are demanding for a property, right? Obviously, there's various ways that we price an asset, and that is that's really what this is all about, right? We're trying to determine the most appropriate price for the deal, and so it's cool to see the consistency there that we're demanding a 20.5% project IRR on average. And obviously that doesn't mean every deal should be priced at that level, because that doesn't account for risk. And if a deal is riskier, we're going to demand a higher IRR. If a deal is in a great location, newer vintage, checks all these boxes, we'll be okay with accepting a lower return. So that's just something to keep in mind as well. Anything else that we wanted to mention as far as the IRR goes?
Well, I mean, I think, there was a range, in what we were solving for here. So, I mean, just looking here in Excel, I mean, you've got kind of minimum 10%, maximum 62%, depending on kind of the profile. So, we can just see there's like, 16 here, I mean, that's towards the low end for sure, 16. I think this 10 here is super low because, this is going to be the entire project before fees. And so it needs to, be pretty formidable to actually be economic to do the deal. And yeah, so I mean, also interesting, I think, was that it appears that, while we're getting the same 20.5, we're doing it on slightly lower unlevered IRR. So, last quarter we ended up around a 10.1% unlevered internal rate of return, and this quarter this most recent quarter, it's been closer to 9.6. And so I think probably to some extent that might be because of financing continuing to get a little more creative and making deals doable.
Yeah, so for just to say it again, for those that might have missed that, we on average solve for the same levered IRR, but our unlevered IRR actually went down this quarter over last quarter. And so obviously what's the difference? It's leverage, right? If the unlevered is, if they're here on an unlevered comparison, but then at leverage, they end up at the same number, that means in one of the data sets, leverage is more accretive, like Charles said. So, and we've all seen that coming out of COVID, lenders getting more comfortable, LTVs going up, terms getting better, COVID reserves going away. So that's good to see. And you can see that, while it's good to buy a fundamentally sound asset, at the end of the day, you have to base your pricing and valuation on debt and what's available. So debt heavily influences value, and we're seeing that show up there. So we got a couple questions. Peter is asking, how low of an irregular IRR
IRA.
will you accept? And so I can answer that, based on our rules, which is, and this is on a net IRR basis, not a gross. And so in the tracker here, we have gross IRR here, but on a net basis, which is net IRR to investors, the lowest we could really, be comfortable going is probably 12.5%. And if you ask me tomorrow, who knows, it might be 12, might be 13, but that feels right, 12.5%. But Charles actually, he just did a quick Excel, grabbed all the data, and we had a 10. I don't know how we were solving for a 10% gross IRR. That feels too low. But Mark's asking, what for your IRRs, what is the investment horizon? So that's a great question. So we put our deals into two different buckets. We have deals that are stabilized and therefore being financed with agency debt, and then we have deals that are bridge deals, right? More of like a buy it, fix it, sell it, or buy it, fix it, refi. And for the stabilized assets financed with agency, we're doing 5-year holds, and now we've been kind of flirting with 7-year holds. And on the bridge loan side, we do 3-year holds because that we want to match as best we can debt term to business to underwriting horizon. So, 3-year bridge loan, 3-year investment period for the IRR. And if for the rest of you that may have questions, feel free to answer that or pop them into the chat anytime. I personally like to just answer questions as they come rather than holding them to the end. So feel free to make that happen. So yeah, well, let's move on to kind of the next insight here.
Well, I've got kind of more more marketed and fewer off marketed, I guess, would kind of be the next bullet point. We sort of touched on it, but yeah.
Yeah, so this is something we think is interesting to keep track of. How many off-market deals are we seeing versus marketed? And not, I guess this isn't seeing, this is actually underwriting, right? And so both we see marketed
And also
deals.
this is ones that were new for this quarter. So like there are a lot of off-market deals that float around, but in this tracker, I only included ones that we saw for the first time this quarter.
Yeah, that's fair. So yeah, like I was saying, we dismiss both off-market and on-market deals, right? We might get a deal and just say, you know what, this is a pass, no thank you, and then therefore it doesn't get fully underwritten and priced, and so it doesn't end up in this tracker. So this isn't exactly representative of the number of deals we're seeing, and then the number of deals that are off-market or on-market, but it is still, we think, an interesting data point to keep track of. And as Charles said, it's more marketed deals, substantially more this time than previously. So yeah. Also, we will include a cleaned up version of this spreadsheet available. We'll send it out to everybody who registered for the webinar, so you can get the spreadsheet afterwards. So just wanted to address that. So yeah, what's
I mean,
next here?
that's useful both if you want to kind of just dig in a little more and kind of, look at kind of where these numbers came from and just, really sort of sit with them and sort of see rather than just this kind of, 30,000 foot view we're giving here. And also, if, maybe if you want to have a starting point for like, if you haven't got one of these yet, it's always maybe helpful for that as well.
Exactly.
So then I guess the next thing would be, yeah, I mean, sort of the underwriting. So you can see we also keep track of kind of the ratio of our Lone Star value to the guidance pricing. So, it's a competitive market, and you're going to do more deals, I think, if you're able to pay more, right? So we're, but nonetheless, it's always very challenging. I mean, you can see most of these we're not really getting there. With the guidance pricing these days, it says, if you can get to 100% alone, you're probably still not going to buy the deal. These days, a lot of deals are going, significantly above, maybe 5. I think we've seen one that went 15% above guidance recently. So, getting to 100 isn't even really enough to do it a lot of the time. But in any case, so last quarter in Q1, we were kind of averaging 90.1% of the guidance on our underwrite. So kind of, we would, 10% discount to be able to buy it. And this quarter, we're down to an 8% discount or 8.2% discount, 91.8%.
Yeah, so we're getting more aggressive, or trying to come up with values that are closer to guidance, so that we get closer to transactability. And like Charles was saying, it's so competitive, and it seems like the new market dynamic is one where if you aren't easily getting to the guidance value, you're not going to buy the deal. We don't have data on this yet. We're working on it, but it does appear that many deals are trading at the guidance or 10% over, which is crazy. So something that's interesting. Historically, my strategy has been, if we are 10% off the guidance price, then let's take the time to submit an LOI. Now, now thinking about this, it's not worth it. I mean, if you're not really hitting the guidance, it's probably not worth submitting an LOI. So Charles, what are we doing these days as far as LOI protocols?
Yeah, I mean, typically, if we hit the guidance, then we'll start to think about what to do. I mean, if it's off market, then it's kind of bombs away. We'll start doing an LOI because there's no fixed process, right? But I think otherwise, if you like it, and it's marketed, either you kind of get it early and you try to preempt it if you can, because while you might, in which case you kind of discuss with the broker and see how that process works. You would either do it a little earlier, and see if you can cut off the bidding war. Which if you're only paying the guidance these days, that's not too bad. And it has to make sense. You can't do this on every deal. But otherwise you might just kind of, take the month of marketing time and see if you're really accounting for all the value there. You send your guys out, or you yourself go out and tour, and you just dig into all your assumptions and get your comps really nailed, and then kind of see how the bidding shakes out. And very often in that situation, you may have liked the guidance, but you may not like it where it ends up.
Yeah, exactly. It's been too many times recently that we like the deal at the guidance, we get all excited, and then in best and final, the value just runs away. It's crazy.
But yeah, like off market, I think you're gonna want to kind of get that LOI in early, and maybe get it even a little like at the kind of 90, a little lower if you can get a counter and stuff. But I think it's definitely these days one has to certainly put out, and the other side of that is just being really on point on not wasting time on deals where you're not going to put out an LOI. Okay, let's stop looking at this.
Yeah, we don't want to deploy lots of time and energy on a deal that and is not going to come to fruition. So we have to be careful with how we choose to spend our time. So we got some good questions coming in. Mark's asking a really great question about I didn't read the full thing actually yet, but I already could tell it's great. The cap rate averages we are using for market basis. So basically what I'm gathering is, for exit caps, right, which are very important in underwriting, we are absolutely not using CoStar data to determine what the appropriate exit cap rate is, or what the going cap rates are in the market, right? CoStar is so off. It's off at least 100 basis points, right? Like Mark's pointing out, CoStar has market cap rate for San Antonio at 5.4%. I'll buy every deal in San Antonio for 5.4% right now. That's just not true. So unfortunately, CoStar data is not correct. And part of the reason why we do this trade tracker is because it does provide excellent data about exactly the types of deals that we are looking at and what are the prevailing cap rates for those deals, so we can more confidently price our exit caps in our models. And we sound smart, and like we have our stuff together when we're talking to investors, and they're saying, because investors love to poke you and say, well, how did you come up with this exit cap rate, and are you right? Are you being too aggressive? And so if we have a little bit of data to back us up, it's very helpful.
Well, it's like if we were being aggressive, we would be doing a 4 cap.
Right, yeah. You're lucky we're only doing a 5 cap. So Omar has a question, do we track the sales price? So this is something that we're working on. it's a lot of work to track the eventual sales price, going back and following up on deals months after, because, the lag time between the deal being launched with a guidance price to when it actually trades can be months, is months and can be longer. We do not track whether it was an institutional buyer or private syndicator. That is an interesting idea, definitely interesting. And then we've got a question: do you further break these down into Class B versus Class C? I don't think we do. That's also a great recommendation. One of the benefits of doing these webinars is we're learning as well. So I don't know, Charles, what do you think about those things?
Yeah, yeah. I mean, I think, well, on the Class B versus Class C, I mean, I think probably most of these would be counted as Class C. Maybe some of them are like a B minus. I mean, I guess some of these you could argue are like a Class B, but I don't know. It sort of depends on your definition. I mean, like, look at the vintage. These are like 1980s deals. I mean, mostly I think if you're not kind of, using your rose tinted sunglasses, it's probably a Class C. And then on the institutional buyer versus private syndicator, yeah, we don't track that formally, but I mean, we do, we do find out about that a lot of the time, on a more informal basis, and qualitatively. And I mean, my take on that would be that I think most of these, I mean, there are a lot of people who are not institutional buyers who are also not private syndicators, right? Like there are like professional equity kind of things or like high net worth. So I think a lot of these assets wouldn't really qualify for like a true institutional buyer, whether that's like a very large, apartment company that has tens of thousands of units or, um, like some big name we've all heard of. But I think a lot of these, the deal sizes here, like, you can see our average deal size is 22 million. That's a little bit kind of towards the smaller side for a lot of those guys, I would say. And so like at the same time, it's sort of too big for like most rich people. So who are not like really rich. So I would say it's kind of a mix. Mostly we're bidding against, I think, a good amount of syndicators, and then like some kind of pretty high net worth people, and like sort of like smaller private equity groups would be my guess.
Yeah, it's something that we wanted to learn about. Charles had a great point. We were talking about this about a month ago. To try to get more competitive and win more deals, we need to understand the buyers out there and what that universe looks like and what their profiles are and who buys what types of deals. And I might be jumping ahead here, but I thought that this kind of serendipitously is a nice segue into one of the things that we can illustrate through the trade tracker is our bias towards deals with strong in-place cap rates. And you might be thinking, well, everybody wants a strong in-place cap rate. Well, actually, not really. Most people are tripping over themselves to buy Class C assets at 3 caps because there's a sexy value add story, right? There's a proven opportunity to raise rents $100 or $200, and you can programmatically renovate interiors and accomplish that plan. And that's what everybody wants. And then if you're talking about like an early 2000s value add, people go nuts, and that's even more competitive. So in reality, everybody says they want a good cap rate, but in reality, people are fine buying low in-place cap rates if their value add story is there. And certainly we're no strangers to value add. Like I said, we bought 1 caps, negative caps. We really like heavy value adds and turnaround plays, but in our opinion, the value in today's market is actually in yield plays and deals that actually going in have strong cash flow. So Charles, why don't you kind of show us the numbers behind that idea?
Yeah, I mean, so it's kind of, well, I mean, I think we can look at kind of which deals have the higher risk and which deals have the lower risk, kind of based on like, our average, spread between cap rate and yield on cost is 1.6, right? So like if you're above a 2 or something, you're probably kind of towards the riskier level, right? And the more value add. So I mean, here we got one 2.5%. So it's a trailing 3 cap. Here you've got another one 2.5%. It's trailing 2.5 cap. And the ones with the really big numbers here, they're all going to be like negative caps pretty much, I think, 9%, 8.6%. but it's really pretty much the classic profile: buy at a 3 cap, and eventually you just get over the line to like, kind of maybe mid to high fives where you need to be to make it work. I mean, there are so many deals like that in here. And you're getting your IRR, but like if your plan doesn't work, then you're not in a great situation.
Yeah, we feel that it's taking undue risk. You're not being paid for your risk by at all. So like Charles said, you might be buying that 3 cap, and the value add is real. You might actually legitimately be able to raise the rents $200, and that's a great success. But you're only getting to a 5.5, or I'd be a little more kind and say probably a 6 cap, which is great. A 6% return on cost rather is very nice, but you took a lot of risk to get to that 6%. And so what we're seeing the ability to buy something as trying to get to as close to a 5 cap going in as possible, and stabilizing to somewhere around 5.5 or so. And yeah, your return that you underwrite when you do that is probably a touch lower than the 3 cap to 6% yield on cost, but think about how much less risk you're taking. And so on top of the operational risk in terms of implementing that business plan, you also have financing risk. So, and in my opinion, that's one of the bigger sources of risk. So the way that I see it is, you have already cap rates across the board, whatever type of deal you're buying, are so low. So all deals are debt service coverage ratio constrained when being sized for leverage on the permanent debt side. So unless you actually do have like a 4.7-ish cap rate, you can't get, what is max leverage for most markets. So for example, in Houston, max leverage, generally speaking, is about 75% LTV. And if you're buying a 4 cap, you're just not going to get to 75%. You're going to be debt service coverage constrained, and you're going to get 65 or something like that. And for us, and of course, if you have only 65% leverage, your levered returns are going to be less, and so that's not good for us. And then we have to raise a bunch of equity, and it's just not ideal. So the way that we look at it is, unless you actually can buy an in-place cap rate of 4.6, 4.7-ish, you you can't get max leverage agency debt. So what do? You have to go to bridge loan. Now, bridge loan has a totally different risk profile, and it's more expensive and more risky. And so for us, the way that we price a deal, if it's a bridge loan, is with a return premium, as we should, because it's greater risk. So it's kind of like this situation where we certainly don't mind bridge loans, and we certainly don't mind risk, but we want to be paid for it, and we're not seeing that opportunity in the market much. So then we're left wanting to buy, like, we want to buy deals with agency debt because it's lower risk and it's attractive. But in order to do so at a good leverage point, we need that strong going in cap rate. So I don't know, I might have missed something there, Charles. What you want to add anything?
Yeah. So I mean, I guess I think, right, it's like, what is financing risk, right? Well, I mean, you have more of it on a bridge loan because, you know, once you reach 3 years, you're paying a point to extend it, and then eventually you're going to get to 5, and you're really going to have to exactly right. You're going to have to find something else, whether that's equity capital or debt capital. Either way, if the situation isn't good, it's not really very good for you. You're either going to, sell it and lose money, or, have to put money into the deal, or whatever. I mean, that's just not great, right? Whereas if you had a permanent debt, then you can just maintain the coverage, and you don't like, and the lender works with you. Like, you're not going to be forced to recapitalize in a bad situation, which is like, that's the real risk with this shorter term financing. And these days the market is getting pretty hot, and so you're seeing deals that are stabilized deals that don't have a ton of upside, where people are just putting a bridge loan on it so they can just pay more, and get more proceeds, and have less equity and stuff. And that's which makes it really tough, and that's a high risk strategy. I mean, so this stuff is happening. But yeah, like I mean, it's not just, oh well, you put a bridge loan on, and like, bridges, we don't like them because they kind of smell bad, and then, but we get more returns, so we're happy to deal with it. It has a real risk at the end of it. I'm just looking at Dan's question here on specific criteria.
Yeah, Peter, I
I
hope
mean,
Charles answered the question about why bridge debt is more risky. it is, it's the maturity risk factor where, the debt comes due in 2-3 years and you might be in a recession at that point, or, well, like Charles explained. So
Right. I mean, like real estate, one of the traditional advantages of real estate generally as an asset class has been like the illiquidity means you don't have to sell when in a bad situation. Whereas like if you were in the stock market, you get margin call. Well, if you put a bridge debt on, you kind of reduce that. And then this thing with yeah, like is it, you decide if a deal is good or bad. I mean, I generally because like you want to look at everything. So I mean, generally first of all, we underwrite even the bad deals, at least at an initial kind of a look, if it fits our kind of core criteria of like size and sort of vintage and all this stuff. There's it's not a huge number of deals, so it can be done. But then, yeah, I mean, I'd say it's less like getting rid of deals because of bad criteria rather than picking out good deals because of good criteria, right? Because most deals are bad. So like whether it's a low basis, this deal is only 60 a door in an area where it's usually 80, or this deal has a going in 5 cap or something, then you immediately are interested. But like a lot of the time, it might just be another deal, and you have to learn more about the comps or something to really be able to give it its full value.
yeah, it's really hard to, everyone's always asking me how to simplify their underwriting process or speed it up. And it's really hard to. And there's also this anxiety of passing on a deal due to your quick underwriting or whatever your quick process is, and then missing out on what was actually a good deal. So that is a concern as well. But we also, like I said earlier, have to be using our time wisely, right? We have a fixed amount of time and we want to do as many deals as we can. So I think looking at qualitative things is the right way to kind of pre-underwrite, right? Rather than trying to do a quick back of napkin cap rate calculation. I mean, to me, that's useless. I would rather screen deals based on, okay, what, the location, what is the median household income, and, maybe vintage, although, we are, comfortable doing older vintage properties as well. But that's my take on how to quickly screen deals. If you quickly look it up and it's in a war zone, uh, you know, that maybe it's not for us. So Charles, I'm not sure what's next on the list, but why don't we queue up the next insight while I take a look at Bastian's question. So
Yeah,
Bastian's saying,
I,
at what point would you consider reducing the target IRR return in a compressing cap rate environment? Um, so yeah, this is interesting. This is a tough one because there's a little bit, if you will, tail wagging the dog here, because as a sponsor, we only have so much leeway in how we underwrite, or more specifically, what numbers we present as far as returns, because investors will just invest with the sponsor that is showing the returns they want to see. So to an extent, investors are driving, uh, kind of return projections, because if investors called us up and said, you know what, don't worry about it, I know the market's aggressive, we're fine with 10% IRR, so just underwrite, don't be too aggressive, it'll be fine. And say, okay, great, we're gonna widen our exit cap by 100 bips and do all sorts of conservative underwriting, which does not exist anymore, and it would be great. But that's not the case. Investors want 15, 16, 18, right? So we have to be aggressive. And so I don't think that answered your question as well as I could, which is why I'll pass it on to Charles.
well, I think, I mean, there's also the issue that investors think that all sponsors are lying. So, I mean, you kind of, it's, if you expect that your assumptions are going to get knocked down, I mean, then, it's kind of a chicken egg, like Rob was saying, or tail wags dog thing. But I mean, I think that relatively, I mean, I would say like, I do think our underwriting is relatively conservative. I mean, compared to some of the stuff I've seen out there, it's absolutely conservative. I mean,
Yes,
which is why we're always losing bids.
right. Proof is in not the pudding, in our lack of pudding. So the but Bastian is making a good point about, okay, compressing cap rates, you need to buy deals on a relative basis, and this is actually one of the most valuable things about the trade tracker, is it provides insight into relative value. In my opinion, you should not, well, we're not in the business of absolute investing, right? We don't pick a number and say, I need a 20 and that's what I'm solving for. What we're in the business of is relative value. So if the market is only giving us, 10 IRRs, well, when we see a 12 come by, we say, oh, that's a good one. We're going to jump on it. And so we'll jump. This is another great segue. Sorry, I'm stealing the show, to the percentile discussion, which, we need to buy deals on a percentile basis, right? Let's buy the top 1% of deals we see, right? And if we look at 100 deals aggressively every quarter, we'll buy a deal a quarter, that it'll work. So, we absolutely are reducing our return targets based on what the market is telling us. I look back at a few years ago in our pitch deck, we were saying, okay, here's kind of what we are looking for as far as returns based on these risk profiles. And I was updating our pitch deck and think, okay, well, we have to reduce all those by 2% because the market's just gotten more aggressive. And so, yeah, that is definitely the case.
Right. And I think you talk about the concept of risk premium kind of a little bit there.
Right, right. Okay, let's. Yeah, Charles, why don't you take it away on the percentiles?
Yeah, we just kind of, if we want to get a sense of what is a good return or whatever, and I think that then, we want to see how it is relative to the other deals we're seeing. And, so I think, well, first we have like kind of what percentage are we relative to the market? And so like for us, we start to get pretty close if like the top quarter deals we can kind of get in striking distance against, right? You're at 97% or something, that's pretty close. And then on IRR, that's, kind of high teens, I guess, per underwriting. And then on cap rate, I think that's got to be value add there if you're 4.3. But what I think one of the interesting, kind of one of the big insights of this is just that the 5 cap, is that's actually a 90 plus percentile level of going in yield. And yield on cost, likewise, top quartile is going to be, 5 point, I guess, 6, 5.7 there, right? So, of course, like these numbers are probably lower than what they used to be, which is because, maybe the risk premium, I'm not actually sure if the risk premium is compressed or not, but like the risk premium over like interest rates went down. And then these went down versus like, I don't know, when people actually believe that every deal should be a 16 or 18, or you should buy 6 caps or something, that's happened already. Do you think you're seeing the full market?
100% we're seeing the full market.
Yeah, no, I think we're seeing the full market in our cap. We're not seeing the full market of like off market $100 million deals in like the class A space. We're definitely not.
Right. Of the market that we want to be in, we are absolutely seeing all the deals. Obviously not all the deals, but it's something very important to us that we see deals, as many as we can, of the ones we want to be seeing. It's very important to us. I get very upset, and it doesn't happen very often at all. But if I see a deal and I think, oh gosh, why didn't we see that? Yeah, that's not a good day. So yeah, that's a good question. And then Mark's asking about our CapEx figures and deal level fees and stuff. That's all factored into our underwriting. Like we mentioned at the beginning, each and every deal here in this spreadsheet there's a full underwriting model that corresponds, which is, rent comps. Not always, but, rent comps, pro forma rents, CapEx, closing costs, everything. Sponsor fees, sponsor structure, it's all there. So yeah, on the percentile thing, this is what really gets me excited, because it informs us how to buy a deal. Not completely, but it does give us hints. So for example, like 90, and also there's anomalies in the data, so it's not as good as gold, but looking at the 99th percentile, a 5.4 cap. So, and it just makes sense. We talked about a 5.4 cap in San Antonio earlier, right? If you could find one, that's a top 1% deal and you should buy it. But that may not always be the case, because that 5.4 cap in San Antonio could be in the war zone. It could be falling apart, and it could need a tremendous amount of CapEx that is non-revenue generating, right? And so this is something that we don't have factored in here, but you could buy, let's say, a 5.4 cap, but if the roofs need to be replaced and a bunch of other stuff needs to be done, then you're actually not really buying a 5.4 cap. If there's no value add there, you actually are getting a yield on cost lower than your going in yield. So that's why you can't just take these numbers. They all work in concert. And so the only one that doesn't really work in concert and is, superhuman is the yield on cost. It is a very strong number. And the only thing that is missing is risk. None of these numbers incorporate, well, the spread incorporates risk, and we can maybe touch on that. But yield on
And the
cost, looking at, we have this one anomaly that is a throwaway, but if you can get a 6% yield on cost, you're in business. And institutional investors are heavily focused on yield on cost. And the ones I'm talking to today, the reasonable ones at least, are saying, yeah, if you can find a 6% yield on cost, we're in. It's a good one. So Peter's asking, what do you do to compel brokers to send you deals so you're seeing all deals? Well, it certainly doesn't happen overnight, but it is a process of being consistent, following up, and doing what you say you're going to do. I recently did a podcast with Bo Berry, who's a broker in Florida, who wrote a great book that I recommend everybody check out. I don't remember what it's called, but Bo Berry's book, I definitely recommend it. And in that podcast, he was he was kind of sharing much more in depth. He's a broker, so you're hearing it from him about how to see deals and how to be a good buyer and whatnot. And his book does a great job of this as well. So yeah, that's
the book is called Multifamily Investors Who Dominate.
yep. Yep. So what other insights do we want to share?
Oh yeah, there you go. I guess I had some thoughts on the kind of, how do you get them to send you? I think it's like twofold, right? There's like both kind of your credibility and track record and stuff that takes time. And then there's kind of just like the basics, right? Like, calling once a month or maybe more, giving feedback on everything, doing it quickly. And then also like not wasting time. So like, you don't want to ask them for information on deals that wouldn't make any sense for you. And like if you can give them a quick pass, that saves them time as well, rather than like following it up in the future. So I think all those like kind of basic legwork, but then of course like the track record and like if you have references and you have money, that takes time.
Yep. So Omar is asking about, given the current conditions in the market, are we considering moving to another market? Not really. Everywhere is competitive. There are no secrets. There's not really any undiscovered or underappreciated markets. Everything is pretty appropriately priced for the most part. And also, like I mentioned before, we're a relative investor. So kind of we're taking what the market gives us, and we want to buy the best deals in that market. And so, and also from a market perspective, it's important to not let the kind of the return chase wag the operational dog, where if we buy a deal here and there and don't have a real base of operations, it just makes things a lot more difficult. So we're focused on Texas with a number one focus on Houston, and we're adding on DFW so that we can increase our deal flow and do more deals. And we probably will add on a new market maybe once a year or every 2 years moving forward, so that we can just continue to grow our portfolio. So yeah, Charles, anything you want to add there? And if not, we can jump into another insight if we have one.
Yeah, I think that was kind of, I think the guy percentile was kind of the last obvious insight of the return metrics. But yeah, on the market thing, I think, people have already been trying to do this, right? Like the secondary markets have been super hot this year and the year before. Right? Like, 2 or 3 years ago, like deals in Lubbock or, Killeen or Amarillo or Nacogdoches were like, what is this place? I'm not interested. Like this has a 7 cap. Nobody wants to buy it, 40 a door, whatever. That's mostly not the case anymore. Like, I think that the pricing on those markets has gone up way more, probably even than in Houston or wherever. And it's maybe even a one-way thing, but if it's not, you don't want to be on the downside of that. And yeah, so like there are deals in Nacogdoches in like the $4 million range that are just being swooped up like well above the guidance. This is all happening already, and So I'm not sure there's a ton to be gained by going out there. And like Rob said about the operational footprint, I mean, it's just, in practice, it's going to take you a lot of effort maybe to extract that extra point or something if you want to like build an operation. And if you can't operate, like, for example, like Oklahoma City, it's tough to operate, I think, or some of these other places, it's tough to operate. And so like, if you don't have the capacity to run that yourself, you might not end up with very good results.
Yeah, a lot of these ideas of reaching for yield creates undue risk that you're not getting paid for. And so the idea about as the market rises and gets more competitive, the risk curve flattens, right? So as typically speaking, right, to be induced to take more risk, you need to have a higher projected return. And that would be the risk curve. And I'll do it this way for you guys. And so, right, so you take more risk and you get more potential return. Doesn't mean you get the return, it's just more potential. But in a hot market, in a competitive market, the risk curve flattens. You take more risk and you don't really get paid much more. And in those situations, right, you have two things happening, right? You get paid less for the incremental risk you take, and returns are just less in general, right? So it's a shift down and a flattening. And in those scenarios, in my opinion, rather than seeking for yield, you should go other way. You should take less risk. And that's what's happening in our acquisitions. As I alluded to before, talking about how we're actually really valuing in-place income because it's financeable, it's less execution risk, and we're going this way. So we might be accepting a slightly lower return, but we think we're not taking risks that we're not getting paid for. So I think that is a good insight as well. So I think we'll answer Bastion's question real quick here. Do we have a property manager walk all the properties for you? At what point in the process are you doing that? Yes, we do. We do that when our initial valuation is coming pretty much at the guidance, and then the broker says, "All right, you guys are looking competitive. You should come check out the deal." And so then we'll have our regional manager go for a tour. So yeah, I think that's pretty much it. Charles, anything else we need to cover? And if anybody else has questions, now is the time to flood them so that we can, have a quick Q&A. But I know everyone's been doing a great job asking questions all throughout. So I really appreciate the engagement. And this will be recorded and sent out here maybe today or tomorrow. So yeah.
That's it for me.
Okay, perfect. Well, looks like we're not getting any more questions. So thanks again so much. And we will see you guys next time.
Awesome. All right. Well, thanks everyone.